Hello again. This is Professor Marsh, and this is Accounting 220, Principles of Managerial Accounting at Newberry College in the fall of 2022. I am going to today talk about your homework for Chapter 2. So this is the replacement lecture for both sections A and B for Friday. And let's go ahead and get your homework out, and let's take a look at exercise set A, and these are questions 1, 3, 5, 6, 10, and 12. And what you'll see is that probably if you turned in your homework, as almost all of you did, and I think some of you might still be working on it because of travel or sports or some other things, but you receive full credit, and I based that on effort, and everybody gave a good effort. So I was very pleased to see that everyone worked hard and tried to address or complete all the problems, or at least advise me if they didn't know where to get started. And so what I'd like you to do is to compare the answers that I suggest are the correct answers to what you were able to determine. And hopefully I have them all right. The book has suggested some of the answers, but not all of them. So, and as the book also suggests, there are sometimes in classifying expenses as fixed versus variable, different people come to different conclusions. So I'll tell you what I think is the correct answer. And if you came up with something different and have a good reason for it, then perhaps that's going to be okay for you. But we'll go through all that in some detail, and hopefully this will help those of you who had trouble with it or were guessing at some things. Just let you know what the at least my preferred answer was, and if you think I get it wrong, then perhaps you should send me an email and let me know where you think I went astray. But let's start with question number 1. This is the Maggio Company manufactures kitchen equipment used in hospitals. They distribute their products directly to the customer, and for the year ending 2019, they reported the following revenues and expenses. Use this information to construct an income statement for the year 2019. Now, I have my homework written out by hand. As you'll see, I've got crossouts and corrections on it, just as you all did, or not all of you, but many of you who did this by hand. And so we can kind of go through what the numbers are. So we want to construct an income statement, and an income statement for a manufacturer is going to have a line for cost of sales, or cost of goods sold, and then gross margin. So actually, I think I put cost of sales. I really should put cost of goods sold. So I'm going to actually have a cross out right here, goods sold. Okay. So here's number 1 up at the top of the page. And let me just show this to you. Sorry for the bad handwriting. But as you can see, it begins with sales revenue of $985,000, and it subtracts cost of goods sold of $489,000. That gives you a gross margin of $496,000. Then you subtract your operating expenses of $245,000, and you're left with net income of $251,000. And you see, I put net profit as opposed to net income, but it's old habits are hard to break. So that's what I got. Almost all of you got that correct. So that was one of the easy ones. And number 3 wasn't much more difficult. This is Canine Couture is a specialty dog clothing boutique that sells clothing and clothing accessories for dogs. In 2019, they had gross revenue from sales totaling $86,500. Their operating expenses for the same period were $27,500. If their cost of goods sold was 24% of gross revenue, what was their net operating income for the year? And so What I did is I took, let's see, I started with 86,500 and multiplied that by 1 minus 0.24, and then took that product, and from that I subtracted the 27,500 for the operating expenses. And so that was the equation I came up with for net operating income. And you can see that on the top line right here. So 86,500 times 1 minus 0.24, which equals 0.76, minus 27,500 equaled net operating income. So just doing the math. And I will post these when I get to a place where I have a scanner. Obviously, I'm out of town right now on another assignment, but we get to 86,500 times 0.76. That product minus 27,500 equals net operating income. And so we get 65,740 minus 27,500 equals 28,240. And again, almost all of you got that correct with no problem whatsoever. So that was the net operating income for the year for K9 Couture. Number 5 was a little more complicated. This asked you to get into the material for the second section of the chapter to identify and apply basic cost behavior patterns, and you had to understand the difference between fixed and variable costs. And so it gave you a listing of the average cost per unit of several items for Rose Company. It tells you that they had a relevant range of production between 10,000 and 25,000 units. Now, what does relevant range of production means? Well, in the materials, you'll see that they talked about predicting costs within a relevant range. You're going to have certain constraints. So if you have a machine that you're using that has a certain capacity and how many units of production it can operate within for a month, you're going to have some top limit where that one machine isn't going to be enough, and you're going to have to incur additional fixed costs or perhaps make a substantial investment in other machinery if you're going to increase your production above the relevant range. So we know that Rose Company, with their current plant, they can produce between 10,000 and 25,000 units, and we're given the following cost data representing average cost per unit for 15,000 units of production. And that's going to be important for us when we have to calculate total costs and get into the fixed costs. But I took all that information, and I think all of you did this, where you listed it. And then what I did over here is I tried to identify what's variable and what's fixed. And so direct material and direct labor was easy. Those are variable costs. Indirect materials, I think some of you had a problem with that. If you read chapter 2.2, section 2.2 of chapter 2, if you read it carefully, you'll see that indirect materials, even though they're considered to be indirect, are things that, remember the example of the yacht company. They had glue and wax and paint and small tools and things of that nature that you really couldn't identify how many boats would be it would take for a tube of glue to be used up, so or a can of wax or something like that. So those indirect materials are really treated as variable costs, and so you can, within the relevant range, just take that cost and use it as a variable cost. So I think some of you maybe decided to use indirect materials as a fixed cost, and so your answer would differ. Then we got fixed manufacturing overhead and variable manufacturing overhead, and that was important to the answer, and I think maybe some of you had some problems with that as well. And then fixed selling and administrative expenses and then variable sales commissions. Now, variable sales commissions are variable expenses, but they're not part of the production process, so they don't really go into the cost per unit of the item. So we usually treat those the sales commissions, both fixed and variable, as operating expenses below the line and not part of the cost of production. So that may be why some of your answers are different. Well, question A was, if 10,000 units are produced, what is the variable cost per unit? And so I took the cost of direct materials, $12, plus the cost of direct labor, $10, plus the indirect materials cost of $2 per unit, plus the variable manufacturing overhead. And when you add $3, so when you add 12 plus 10 plus 2 plus 3, you get $27 per unit as the total variable cost per unit. And then, if you multiply that by 10,000 units, they didn't ask you for this, it'd be $270,000 in total variable costs in the production process. But the correct answer is 27 because it asks for variable cost per unit. Now, here's the silly question or trick question. If 18,000 units are produced, what's the variable cost per unit? Well, if you got it right for A, you should have gotten it right for B because we're still within the relevant range. And so the variable cost per unit is not going to change. So we're still at $27 per unit within the relevant range. Okay, C. Now, if 21,000 units are produced, what is the total variable cost? Well, this is just a multiplication exercise because we are still within the relevant range. And so it's 21,000 times $27, which equals $567,000. If 11,000 units are produced, what are the total variable costs? And we've got 11,000 times $27, which equals $297,000 in total. If 19,000 units are produced, what is the total manufacturing overhead cost incurred? Now here we want to use the formula to come up with total manufacturing costs. And so we're going to have both fixed costs and variable costs. So Y, which we're going to define as the total manufacturing costs, equals A plus BX, where A is the fixed manufacturing costs, B is the variable manufacturing cost per unit, and X is the number of units. So it kind of looks like algebra, doesn't it? It's kind of a, it's an equation, maybe, late high school or, or maybe even early high school, maybe middle school for some of you. But when we substitute in the numbers, we have 60,000 for fixed costs. Now, how did I get 60,000 for fixed costs? Well, we're told that the fixed manufacturing overhead was $4, and we had 15,000 units of production. What they told us in the prompt. So, if you multiply out the fixed manufacturing overhead of $4 on average per unit times 15,000 units, you get $60,000. So total fixed manufacturing overhead was $60,000. Okay, so then if we have 19,000 units, we're told that the variable manufacturing overhead is $3. So we take $3 times 19,000, we get 57,000 for total variable manufacturing overhead at 19,000 units. We add the two together, we get $117,000 as our total manufacturing overhead at the $19,000 unit. And of course, we're still within the relevant range, so everything's fine on that. If 23,000 units are produced, what is the total manufacturing overhead incurred? So now we just change the formula. So we take out 19,000 units, we put in 23,000, and we do the math on that. We've got 60,000. Remember, the fixed costs don't change within the relevant range, and then the variable costs 3 times 23,000 is 69,000. We have 129,000 in total manufacturing overhead costs. So that's F. Now G asks you to come up with, if 19,000 units are produced, what are the per unit manufacturing overhead costs incurred? So remember that we had 117,000 as our total manufacturing costs. That was in problem part E. And then we had 19,000 units, so we just divide 117,000 by 19,000, and we get rounded $6.16 per unit. So that's the answer to G. Now, I fell into the trap of using 23,000 units for H. So you can see I did the math on that, and then I had to say, wait, that wasn't asked. It was actually 25,000 units. So if H is if 25,000 units are produced, which is that's the top of our relevant range. So if we went above 25,000, we went to 26,000, then we're going to have to buy some more machinery or do something or get a bigger factory or who knows what the constraint is. But that's above the relevant range if we went to 26,000 units. So at 25,000 units, where we're just at full capacity, then what you see, if you do the equation, it's the same old equation, y equals a plus bx, 60,000 in fixed costs, $3 in variable costs times 25,000 units. 3 times 25 is pretty easy calculation. That's 75,000. 60,000 plus 75,000 is 135,000. And when you divide 135,000 by 25,000, you get $5.40 per unit. And that's the answer to H. Okay. All right. Well, that didn't take long, and that's about the first half of the homework. So then let's go on to number 6. And number 6 was also a little more complicated problem. You have this this chart here for a car company which provides human resource consulting services. So it's a service business to small and medium-sized companies. Last year, CAR provided services to 700 clients. Total fixed costs were $159,000 with total variable costs of $87,500. Based on this information, complete this chart. And so, like many of you, I completed the chart like this, and you can see I just tried to copy what was in the book. And so, 500 clients, 800 clients, 900 clients. Total cost, you got fixed costs of $159,000. That doesn't change. That's the same whether it's 500, 800, or 900, assuming that 900 is still within the relevant range for this business. Then variable costs. Well, how did we get variable costs? Well, I had to do some math down here. So I took 87,500 and divided it by 700. And you can do this in your head, really. First you cancel out the 2 zeros, top and bottom, okay? And then you get 875 divided by 7. So as Jethro Bodine used to say, 7 goes into 8 once. Okay, so you got 1. And you have a remainder of 1, right? 8 minus 7 is 1, so then 17. 7 goes in twice. Okay, 14 minus 17. So you have a 2 here. You got a remainder of 3, 3, 5. Okay, 7 goes into 35 5 times. So the answer, as far as the variable cost, is $125 per client is your variable cost. And so then you just have to do the math, and you can do this math in your head too. 500 times 125 is 625 with 2 zeros on the end of it. For 800 clients, it's even easier because 125 times 2 is 250, and so 250 times 4 is 1,000. Add 2 zeros on that, you got 100,000. Then, and of course, 2 times 4 is 8. So And then 900, well, you just add 12,500 to the result you had previously, and you get 112,500. Okay, so then you just do addition, and that gives you your total costs at each level of clients. Now, down here, you're supposed to come up with the cost per client. Well, the variable cost you can fill in right away because that's going to be 125 all the way across, okay? Variable costs don't change on a per client basis. They change on a total amount of costs, but not per client. And then the fixed cost, excuse me, what we learned in the chapter is that with higher levels of activity within the relevant range, you can lower your average fixed costs, and that's what the pattern that we see. So we're $318 dividing 159,000 by 500 gives you rounded $318. And then for 800 clients, you've got 800 clients, almost 160,000. It's almost 200,000. You know, if you had 200,000, I'm sorry, 160,000 here divided by 800, you'd have $200 per client, but here you have 199 when you round it in fixed costs. When you go up to 900 clients, the cost, average fixed cost per client, you divide 159 by 900, you get $178 per client. And so then these are your total costs per client, and you can see a declining pattern. The more you're able to utilize your facility, the lower your fixed costs per client. And so that's the pattern right there. And I've got the math for the fixed costs down here too, so you can take a look at that. Let's go on to the next one, which was number 10. So in number 10, you're given cost data from Hickory Furniture for the year 2017, and it's just each month. Hickory Furniture produces tables, and you're given the factory utility expenses. So your job as a managerial accountant is to use the high-low method and express the company's utility cost as an equation where X represents the number of tables produced. So, okay, this is this is kind of like what you may have done in math, you know, back again in middle school, or perhaps, you know, freshman, sophomore year of high school. It's a just kind of a simple, you know, taking two plots, two lines, 2 points. I'm sorry, 2 points on a graph, and constructing a line to estimate the slope. And it's just a very rough estimate of the cost on a per unit basis of utility expenses. So it's and of course it's assuming that none of your utility expenses, you know, are kind of fixed or built in, where you might you know, you keep the factory open on you know, Sundays and holidays, and so you're not perhaps working on those days, but you've got you know, the lights are on, security's on, maybe the air conditioning's on, etc. Even when the factory is shut down, or perhaps you have a period of time, you know, where, you know, you're on hiatus and you still have to run some of those things. So there probably is a more precise equation you can come up with, but the high-low method is a quick and dirty way to estimate the average and per unit cost of some expenses. And it's basically, the equation is rise over run. Remember that from algebra? So, you know, if we take the y-axis and we make that the factory utility expenses, and we plot the highest point, the largest number of tables produced, the cost was 3,281 for November, and that was at a level of use of 875 tables produced. And then the lowest point was April, and that was a cost of 1,823 for the month, and only 470 tables were produced that month. And so here are the calculations for that with the high-low method, and it's basically y2 minus y1 over x2 minus x1. So your highest point minus your lowest point in terms of cost over your highest volume minus your lowest volume, and then that gives you the cost per volume. So our cost per unit. So we have 3281 minus 1823 over 875 minus 470. That reduces to 1458 over 405, and it gives you a cost per table of $3.60 in utility expenses. So that's kind of a quick and dirty calculation that we can use. So then you use this to predict the utility costs if you're going to produce 800 tables. And so you just do the math and you do $3.60 times 800 tables, you get 2880. And if 600 tables, $3.60, you have 2160. So, and then many of you, certainly not all of you, but many of you did make a nice scatter graph, and I will post my scatter graph when I post the rest of these materials. But you can see that there actually is kind of a linear function here, and so you can see that you probably could do a least squares calculation on these data points and come up with a more precise equation. And there probably is some y-intercept positive number that represents the cost of keeping the thing heated and cooled during the during the time that the factory's down. Okay, so that's number 10. And then for number 11, this was the copy machine question. This is Markson and Sons leases a copy machine with terms that include a fixed fee each month of $500 plus a charge for each copy made. And they use the high-low method to analyze cost. If Markson paid $360 for 5,000 copies and $280 for 3,000 copies, how much would Markson pay if it made 7,500 copies? Well, presumably 7,500 copies is still within the relevant range. And so you can see that this is another one of those rise over run calculations. What you're given is the fixed cost of 500 per month as the basic copier lease charge, and then a per copy charge that when you do the math works out to 4 cents per copy. So you can see that 360 minus 280 is $80 is the difference between the high and the low. 5,000 minus 3,000 is 2,000 copies. $80 divided by 2,000 copies is 4 cents per copy. And then so you multiply 4 cents per copy times 7,500. You get $300 for that. 500 plus 300 equals 800. And that is the total that Markson would have to pay if it made 7,500 copies in a month. So that's that. I hope you enjoyed the questions and answers, and I hope that it's helpful now in understanding how to do these calculations. We will need to know the high-low method of estimation of costs going forward, and also how to calculate total fixed costs per unit, and also how to calculate total variable costs, knowing and then being able to predict variable costs based on the number of units we estimate to have in the future. So with that, I'm going to say goodbye for now. Have a great day, and I'll talk with you soon. Thanks a lot. Bye-bye.